2013 will not be remembered as a great year for tanker market. Vessel owners were earning almost less than operational costs in some instances. Reasons for that were mainly that demand in major markets of US and Europe was very low due to prolonged economic crisis. On supply side, there has been some reshuffle as well, with United States upping their production, and there's been some political crisis in Libya, obvious Iranian sanctions and security problems in Iraq. Those few things basically influenced very low demand on oil and consequently tanker space. We've seen some improvement on certain routes and a certain size of vessels, namely VLCCs, towards the end of last year. That was mainly influenced by the demand from China. That demand is, however, seasonal and has been also influenced by strategic petroleum reserves top-up or a second phase that has been done in China recently. There has been some spikes in recent weeks regarding Aframaxes and Suezmaxes as well, but that is highly likely to remain just as one-off due to weather problems in Mediterranean and US Gulf. What we can expect for next year is essentially that OPEC is probably going to keep their production levels at 30 million barrels a day. That has been agreed to on their latest meeting end of the last year. The main focus in terms of politics and security will remain with Middle East, with some good news regarding Iranian sanctions coming obviously from a recent agreement between P5+1 countries and Iran. We can expect steady increase in Iranian production. However, that increase will be dependable on politics within Iran itself and politics outside of Iran, as well as their technical capabilities of recovering that production. Another question that arises from Iran sanctions, actually lifting the Iranian sanctions, would be what would happen with 37 VLCCs that are in possession of NITC. That would probably add to significant capacity overload in VLCC market, and recent study that has been done by IHS Maritime and been published in one of our magazines shows that about 2/3 of NITC fleet actually is already trading between Iran and Far Eastern countries that are allowed to trade with Iran, while 1/3, or actually better say about 1/3 of the fleet being used as storage tankers, and that's usually older vessels. In terms of security situation in Libya, there has been a recent incident involving Libyan Navy and Turkish owner Aframax that adds on further concerns regarding Libyan situation and possible recovery in Libyan oil production. It seems that last year US quite easily recovered for lost production in Libya by upping their productions. And interestingly enough, the United States productions has a huge implications on import of crude oil in the United States. The IHS energy reports identified quite a few countries that might influence the growth of oil production. Those countries were not mainly OPEC countries. Those countries are identified as United States, Canada, possibly Brazil, and few other countries about Central America. That obviously is not a straightforward process. It's going to be dependable on investment in infrastructure and basically overcoming the infrastructural and investment obstacles in production of oil in those countries. Apart from that, huge possibility for some better input in oil markets lies with Iraq and Libya itself. US refineries has been enjoying a period of renaissance, highly influenced by cheap oil coming from US itself, but also shale gas. US refineries have much better profit margins than some European counterparts, and those higher profit margins been influenced, as I said, by cheaper feedstocks coming out of United States and cheaper energy, prices in the United States and cheaper operating costs. That had a detrimental effect on some European refineries that had to cut their capacities due to obviously not being competitive enough as compared to US refineries. More bad news for European refineries is opening some super refineries and higher investment in Middle East and Far East and India subcontinent, as obviously the product market is moving naturally towards the market of consumption. European refineries also suffered a weak period of growth in European economies, so that's more bad news for them. That consequently influenced some trade on North Atlantic routes coming out of European refineries going towards US coast, especially in gas oil and naphtha. European refineries increasingly try to find their market in Far East regarding some products, but as I said, that is being influenced by heavy investment in refinery capacities in those countries. Looking forward a few years, high investment is expected to happen in Far East, predominantly China and India, while also some Middle Eastern countries as well as some Latin American countries are planning to invest high amount of money in their refining capacities. That's normal as predictions, econometric predictions in terms of growth of population as well as spending of fuel per capita is probably going to go higher for those countries in the next few years as they keep on industrializing their countries. So the demand actually for refining products is going to be higher. What we've seen in last year is very low freight rates for tanker owners. As I mentioned before, that those rates improved in certain sectors and in certain trades, especially the VLCC sector towards the end of last year. And there has been some recent spike in Aframax and Suezmax rates within last few weeks, but that's predominantly due to weather factors. The fact is that tanker market is it suffers from overcapacity itself, and that some significant or sustainable freight rate improvement may be expected in case that capacity is capped. There are a few bits of good news and bad news for tanker market owners. Good news is that those new deliveries have been pretty much rolled out in the last few years, so there shouldn't be any more significant adding to the capacity. Bad news is that according to IHS Maritime statistics, tanker fleets is very, very young. So the certain amount of vessels that is older than 15 years is not high actually. By no means 15 years old vessel is an old vessel, especially not well-maintained vessels. But in the last few months we've seen few scrappings of some VLCCs that were about 15 years old. And that in some way doesn't represent economical sense, while there are certain arguments that are going that way. Those arguments are that 15 years old vessels are usually nearing special survey, and those special surveys means that the vessel is going to lose a certain amount of money of trade, as well as there is a high possibility of some very, very expensive steel work being done on the vessel. To add to that problem is that charterers now can choose obviously younger vessels, and they would probably opt out for younger, for a younger fleet rather than go for the older vessel. On top of that, we have seen some recent changes in environment regulations, and that means that owners will have to invest significant amount of money in order to comply with the regulations. IHS is currently working on a study regarding what kind of bunker fuel will be determined in the future, and that might go way of LNG, or might go way of scrubbers, or might go even of a way of low sulfur bunkers. Either way, those three options will cost ship owners. Scrubbers will cost probably in a few millions in terms of installing and a lost revenue, while installing some cleaner engines would probably mean the same. The other options for owners is obviously to wait and see, and obviously risk to risk higher bunker prices in maybe not so good freight levels. So to conclude, any future freight rate improvements would probably be expected if certain tonnage lowering can happen within tanker market.